Let's talk about building wealth. Specifically, the parts of personal finance I like to focus on to get the most out of my financial strategy. These are the 5 categories of assets and accounts I believe cover the necessities of what to do with money. Cash is a great place to start because it doesn't really entail the buying and selling of another asset. Cash is quite literally the most basic form of wealth. And although the value of cash is constantly undermined by inflation, it's still worth holding on to. In the context of building wealth, the focal point of cash needs to be about the security it provides you, so that you can take more risks with other assets. And security here means the ability to comfortably cover bills and emergencies. With that said, it's important that you know how to budget your money. If you're spending every dollar you earn and there's nothing left over to put away, in other words, you're living paycheck to paycheck, you'll never be able to build a reserve of cash as security. To maximize your cash, you'll need to understand your spending, determine where you're living above your means, and tackle any debt that's holding you back. Then, you'll need to decide where to keep your dollars. Cash can be housed in the traditional checking and savings accounts, but I personally don't see the benefit of that unless it's to initially receive my paychecks or pay bills. I say that because there's a much more effective alternative, a high-yield savings account. With a high-yield savings account, you earn above market interest on accessible dollars. Meaning, in a traditional checking or savings account, you could expect to earn no more than half a percentage point of interest a year. But in a high-yield account, interest on deposits is north of 4%. You earn 10 times the interest for the same amount of deposits. To not leverage a high-yield savings account is to leave money on the table. So it's a great place to store your emergency fund, down payments for property, and cash for any other big purchases you may want to make. How much cash someone should be holding is highly dependent on their situation, and also changes with their preferred method of investing. For me, I have a general goal of cash representing 10 to 15% of my overall wealth. Right now, that's closer to 40. So I am no longer stockpiling dollar bills. After you have the necessary amount of cash saved up to feel comfortable with investing, the next thing to focus on is your retirement accounts. These are your 401ks, your traditional and Roth IRAs. These are the tax advantage accounts that are really effective vehicles for building wealth. To maximize your retirement accounts, first determine if the tax advantage is front or back-loaded. For instance, the 401k is front-loaded, meaning contributions you make to your 401k can be deducted from your taxable income for that fiscal year. The caveat is that come retirement, you'll pay taxes on the 401k's appreciated value. The reason this matters is because you want to know when you'll be hit with that tax obligation and at what tax rate. If you think by the time you retire, your only source of income will be your retirement account, front-loaded tax advantages are great. But if you think you'll be amongst the wealthier tax bracket, which I hope we all will be, then back-loaded advantages, like in the Roth IRA, are the way to go. That's not to say you can't have multiple types of retirement accounts. I see no harm in having both a 401k and a Roth IRA, but it does introduce priorities. Here's what I mean. The way I see it, I'm betting that I'll be in a high tax bracket 40 years from now. If my plans pan out, my income will be high, but so will my taxes. So to me, the tax-free growth of a Roth IRA is huge, way more important to me than the tax savings a 401k would give me today. But the 401k typically comes with something that makes it very appealing: employer matching. If your employer matches 401k contributions, you simply have to take advantage of that. It's not only free money, but it's quite possibly the easiest way to earn a 100% return on your investments. So with that said, what takes priority? I would maximize 401k employer contributions first and foremost. Earn that easy 100% return and enjoy some of the tax savings. If your employer matches 2% of your $50,000 salary, hit that $1,000 contribution and you'll instantly have 2. Then I would pivot to the Roth IRA and max that out. For 2023, the most you can contribute is $6,500 if you're under 50 and fall under the income limit. You can find those on the IRS's website. And then after that, you can decide if you want to go back to your 401k and try to max out your contributions beyond the employer match, which is now $22,500. Let me just say, if you're investing $20,000 in your 401k, good for you. For many people, the bulk of their investing will take place inside a retirement account. And that's okay. A good investor understands that investments compounded until retirement are extremely lucrative, and therefore isn't deterred by long-term horizons. If your financial journey stopped here, you'd still be in a great financial position down the road. The focus on retirement accounts is about not only generating tax-advantaged wealth, but also to give your future self some freedom at a time your earning power takes a hit due to age. Because of the contribution caps and withdrawal limitations that come with retirement accounts, the next account that can be used to further your wealth is a taxable account, or better known as a brokerage account. This is an investment account that allows you to buy and sell the same types of assets available to you in retirement accounts, but offer more freedom around the amount you can invest and how you can handle the account's funds. So in other words, you're giving up tax advantages in exchange for more accessibility. One of the largest drawbacks to retirement accounts is the early withdrawal penalties that come with them. But in theory, this shouldn't be a problem because long-term investing is about buy and hold. So for me, the biggest selling point for brokerage accounts is the no limit on contributions. Once I max out my Roth and once I max out my 401k's employer match, I need more room to continue investing in stocks. That's very easy to do in a brokerage account using a simple S&P 500 ETF like VOO or SPY. With that said, that brings up something I want to say about the 401k. The reason I don't contribute to a 401k beyond the employer match is because I'm not a fan of the way 401k funds are structured. More times than none, 401k funds entail higher management fees and expense ratios, even for passively managed indices. On top of that, many 401ks offer a very limited selection of funds. It's the lack of control that bothers me and why I prefer to move to a brokerage account after maxing the employer match. Another pretty specific reason why I like to use a brokerage account is because of how I approach more speculative positions like individual stocks and options. Two things that I don't think is necessarily the best for retirement accounts, where you should keep your realized losses at zero. By separating speculative bets from my long-term investments, there is no intermingling of different risk profiles. A brokerage account allows me to do exactly that. I don't want to be taking the same level of risks with retirement funds that I do with individual stocks and options. The truth is, most people shouldn't even consider these types of speculative positions. If they just stick to the S&P 500, I promise you, they'll outperform me in the long run. And I understand that. I'm okay with the expectation of losses. The only reason why I do it is because of my personal interest in the challenge of single stock positions. But if we're talking about optimal investing, stay away from speculation. Another major component of wealth is going to be non-stock assets. These are your bonds, your real estate, your commodities, and other unique assets like art or cryptocurrency. This is the part of wealth that will really vary depending on your individual situation and your tolerance for risk. Bonds like treasuries and commodities like gold or silver are assets that typically define a defensive portfolio for those that are looking for consistent, non-volatile returns. And on the other side of the spectrum, you have risk assets like crypto with tremendous upside, but also some serious downside. Where real estate falls on that spectrum is a bit hard to measure because there's a lot of ways to expose yourself to real estate. The presence of leveraging debt alone is enough to completely alter the risk profile of any real estate position. And if you consider how the types of real estate can change things up too, you quickly realize there's no catch-all portfolio type that covers the entirety of real estate. My point in all this is that this part of wealth can be as simple or as complex as you want to make it. It can be incredibly risky, or it can be incredibly safe. The key to mastering this aspect is understanding not only yourself as an investor, but the true nature of your investment's risk. You can't be investing in crypto without being fully aware of the speculation that surrounds that space. Another point worth making is not all investing strategies are going to be right for everyone's lifestyle. Depending on how you go about investing in non-stock assets, you may have to be extremely involved in managing those assets. Much more involved than if you were investing in the S&P 500. We only have so many hours in the day to dedicate to managing our investments. If you're working full-time, maybe have a family or other obligations, is it reasonable that you invest in something that requires your full attention? The first couple of things that come to mind are crypto trading, collectibles, and physical real estate. These are all forms of investing that take time to not only understand the marketplace, but to then manage these assets as those market dynamics change. Think about how many questions surround the current housing market, and imagine if you were heavily into rental properties. You'd have a lot of work to do. So when it comes to non-stock assets, be honest with yourself about how much time you have to dedicate to it, and then go from there. Let's address income as a component of wealth, because it may be the most important in the grand scheme of things. The bottom line is what you're earning will directly impact how much and how quickly you can build wealth. The higher your income, the more opportunity you have to invest. There are a lot of people that unfortunately do not make enough money to go beyond the cash component of wealth. Building up your savings is hard enough as is, so throw on top the need for an emergency fund, and you can see how it's a challenge to start investing comfortably. In more extreme cases, for those living paycheck to paycheck, even cash savings aren't possible. If the decision is between investing in stocks or paying your utility bills, well, it's clear how investing just isn't an option. So assuming that you've learned to properly budget and manage that inevitable lifestyle creep, as you raise your income, you'll have more money to allocate to your savings, your retirement, and other investment ventures. When you make enough money to not worry about the month-to-month finances, investing becomes a lot easier. The topic of how to best maximize your income warrants many videos. But I will say this, your income is a function of the skills you bring to the marketplace. Not necessarily always how hard you work, but how valuable the work is that you do. When it comes to the income component of wealth, the goal should be to invest in your skill set. That can be through higher education, certified training, or just plain on-the-job experience. Identify what types of skills are and will be valuable to a group of people, and then leverage those in exchange for higher earnings. Here's where thinking like an entrepreneur can really benefit you. Look to be a problem solver and a positive market disruptor. Whether you're in a 9-to-5 or self-employed or own a business, the more value you bring to the people that hold the money, the more they'll be willing to give it to you. Well, this video has gone way beyond what I originally intended, so I apologize for any of the tangents. But that's all I have for this one. The 5 components of wealth that you should be focusing on: cash, retirement, taxable accounts, non-stock assets, and income. If you enjoyed the video, I welcome you to subscribe to the channel, or check out a few others when you have the time. As always, thanks for watching. Until next time, take care of yourself, and best of luck.